as part of the 50th Foundation Year Lecture Series at the Center for Development Studies. Today we have a very distinguished speaker among us. He is Professor Thankom Arun, who is a professor at Global Development and Accountability at the University of Essex. Currently, he is also a professor extraordinaire at the Stellenbosch Business School, South Africa, and a research fellow at IZA Bonn. He is also chairing an academic steering group on financial inclusion in the International Cooperative and Mutual Insurance Federation, ICMIF. Previously, he has been holding various other academic positions across other universities and institutes. And one thing that we must keep in mind, or rather I should mention over here explicitly, is that his association with the center goes way long back, because he's done his MPhil from the Center for Development Studies, post which he did his PhD from the University of Manchester. I must mention he has published more than 53 journal articles in well-reputed top-notch journals. He has also authored 4 books and several book chapters, and has been working on several funded projects as well. His research interests span across finance, accounting, and development, particularly in developing and emerging country contexts. He mostly uses a multidisciplinary approach to examine the problems created by the uneven relationships between business, society, and economy. The topic of his talk today is mainstreaming financial inclusion. He will examine the challenges in managing the sustainable relationship between financial institutions, processes, and outcome in mainstreaming financial inclusion agenda in India in a global context. So you have about an hour to speak, post which we will take questions from participants. I request the participants to please mute your mics to have an uninterrupted and smooth session. Once the floor is open to the participants, you may unmute yourself and ask your questions. Alternatively, you may also type in your comments or queries in the chat box and I can read them out. Once again, I extend a very warm welcome to you, sir. The floor is yours.
Thank you. Thank you, Ritika, for those kind words. Yes, my association with CDS goes back even before my MPhil days. I remember visiting CDS while I was a master's student at the University of Kerala, Karivattam campus. Later on, I spent nearly 5 years for my MPhil and early years of PhD in the center. In between, I was working with the State Planning Board, and particularly on 8 5-year plan and a couple of annual plans at that point of time. I remember my discussions with CDS colleagues at that point of time, and also used the library quite extensively. And a couple of years back, I spent some time in CDS as part of my sabbatical, again able to rekindle my association with colleagues and the institution. I fondly remember my discussions with masters and PhD students at that point of time. So it's altogether a bunch of nice memories about the institution and colleagues. And thank you, Professor Sunil Mani, for inviting me to be part of this 50th Foundation Year Lecture Series. So with these words, let me move on to my presentation today. I have titled it as Mainstreaming Financial Inclusion. It does not belong to a single research paper, but since 2012, I've been engaged in a couple of ESRC research projects on financial inclusion in many parts of the world, particularly in Africa and then in India, and not alone in India, but in Bangladesh, Sri Lanka, a couple of countries in South Asia, even in Africa, about Ghana and Tanzania, other than South Africa. So I thought I have got some kind of reflections over these various projects about the challenges in mainstreaming financial inclusion. We all know that financial inclusion is a buzzword these days, but there are the challenges related to sustainability not only from the demand side challenges, but from the supply side challenges as well. So I just want to give a view of these challenges in my presentation. Some of my research on financial inclusion is actually provided in the website given. So today, out of this broad coverage, I want to highlight on two specific issues. From the supply side, there's a problem for the providers, the capacity, the sustainable capacity of the providers in continuing the financial inclusion. And I just want to see what sort of challenges on our public sector banks in India in the context of PMJDY. So that's the one part of my presentation. The other part, I just want to see the structural and behavioral constraints among the households. For instance, there may be the lack of information capital or lack of trust or many other factors might contribute to lack of engagement with the financial inclusion agenda. Let me move on to my first slide. Here I want to portray the emerging importance of finance in the course of development. And many commentators, they have looked into the emerging pop star status of finance here. There is an increasing importance of financial markets, a deeper inquiry into the financial motives, financial institutions, financial elites in the economy, the governing institutions, and that is happening both at the national and international levels there. And more importantly, the accumulation of profits that occurs primarily through the financial channels rather than the trade and commodity channels in the past years. So all these push the financial activities, both at the micro and macro aspects of the national economies, in a dominant position. So a big move from the production and service-oriented economic activities to finance. So it has actually provided some kind of that's why I said it's provided some kind of a pop star status for finance here. And more importantly, commentators like Niall Ferguson, and they argued, the financial history that has become something very, very essential backstory behind all history and the evolution of credit and debt that is as important as any other technological civilization in the technological innovation in the rise of civilization. So that's very interesting. There is a shift in the understanding and the employment of the word finance by the modern society. And you can see the genesis of this in relation to the discussions between state and market, which we had witnessed in 20th century in different contexts. And the implications of that you could see in the case of financial institutions as well. So after the World War II, we all started, most of the newly independent economies and others started a massive government-based buildup of financial system all over the world. But it has raised its own rigidities and some kind of a controlling of financial capital, the free movement of the financial capital, and we all know that led to the discussions by Mackinnon and Shaw independently through some classic work. But even before, we have recognized the importance of financial intermediaries in Schumpeter's work much long back. But after that, this kind of state-oriented finance has come up, And then the McKinnon and Shaw, they provided the kind of theoretical background for the benefits of a liberalized financial regime. So that is something remarkable there. But still, had to wait few more years to see the empirical evidence emerge from King and Levin onwards. So altogether, there's a good coverage of materials about financial opening up, and you can relate that to the financial sector growth, etc. But the broad view of financial development, it has been shown to promote economic growth at the national and industry or the firm levels, as well as its impact on enhancing productivity growth or capital accumulation. And all those things are actually covered by some of their work. But at the same time, particularly from 2000 onwards, some work has actually highlighted its importance on income equality and also its impact on the poverty alleviation, etc. So that's a change from a growth narrative to suddenly the shift has occurred towards more inequality or the finance and development literature there. And commentators like Beck or Levin again, Demerick, and they all looked into the financial debt, the role of financial debt, and its possible benefits on income equality and also the poverty alleviation debate. And we know financial debt, we normally look into private credit to GDP. But if you go by that indicator, many countries may have similar levels of financial debt, but at the same time, they may not have enough broader financial development in their sector as a whole. So allocating capital, that has become an important issue. How do you collect the capital? How do you distribute the capital among the wider sections of the society? And that sort of narrative actually led to the issues of financial inclusion. And many commentators have pointed out a large percentage of your population is not banked. So basically, you are missing the boat because there are quite a lot of people in the market. They could be part and parcel of the financial transactions, but that is not happening. So that is something. This kind of analytical work, it provides a foundation, maybe may not be directly to the financial inclusion, but definitely provided a foundation for the role of financial development on income equality, poverty alleviation, and that sort of issues. Then from 2015 onwards, a bunch of IMF and World Bank economists, and they have started producing papers based on panel data. And also they developed some kind of new indicators in the context of existing financial debt indicator. And then they have argued in such a way that, yes, the financial inclusion programs have an impact on this income equality and poverty alleviation thing. So maybe I would say the literature which has appeared mainly as the IMF or bank staff working papers, they produce some kind of further evidence towards impact of financial inclusion on income, the equality, or the financial development broadly. So this is the analytical bit of financial inclusion there. So the there is a credit rationing kind of Stiglitz-based kind of thing, but I just want to see it from this side. So when we look into the financial debt and then moving from financial debt to the financial growth and inclusion kind of debate there. But during the same time, there were quite a lot of things happening in the field. Normally, we always say, there's a gap between the theory and the practice. And it's very well evident in the case of financial inclusion. because from 1980 onwards, Stuart Rutherford and many other practitioners around the world, Kiri Girivardhane from Sri Lanka or Muhammad Yunus from Bangladesh, and they all have actually come up with a good set of knowledge, arguing that, look, poor, they need services. It's very important. Like anyone else, they have life cycle needs or emergency needs. And they also want to start some kind of micro enterprises. More importantly, there is a need for them because they work in different parts of the world. The migrants work in different parts of the world. They need to send back money to their family and relatives, and they need to access the funds. Is there a mechanism for that? So most of their needs are, so that's a big realization that most of their needs are in line with what others feel or what others experience in their life. So they need a wide variety of services. It's not about a line of credit, but they need something beyond that and how you can provide. And that actually led to a revolution in the field of microfinance, like started with the Grameen model, BRAC seeds in Sri Lanka, and many organizations. Even in India, we have SSG bank linkage, bank NGO link models, and organizations like Seva or many others in India. So the kind of a range of institutions, they don't have, we can't say that A equal to B, because most of these institutions follow different patterns, but altogether their objective is mainly to help poor or provide financial services to the poor. So that was their objective. So I call that evolution of microfinance institutions as a revolution. And you have a range of institutions there. So that has happened practically. And then we have this, most of these institutions, I need to admit that it's not kind of a linear growth experience. Even in the case of Grameen Bank, they started with the credit only model, and then they realized the importance of credit plus. So they started with credit and plus. There are 16 parts of the oath taking and some others actually community building, and they all became part of their process. Then in 2000, early 2000, they faced huge financial difficulties in terms of sustaining the operations at that point of time. And then they have introduced something called a Grameen highway. That means you can get a credit, but in between, if you have a problem, you can move out of that highway and sort out your problem. And then later on, come back and get a larger credit, get a larger period, and then continue in the highway like anyone else. So this Grameen highway is something remarkable, I would say. If we look into the experience of formal financial sector, and they took quite a lot of time. Even now, I'm not sure whether they have reached that. But these institutions built the kind of trust among its borrowers, and that trust is actually reflected in the revised Grameen highway, as I explained earlier. So most of this, my point here is that regarding sustainability of these institutions, and they have sustained because of a lot of innovations happened in their period. It's not like a straightforward action, but over a year, quite a lot of innovations happened, and that innovations actually reflected them to sustain in the business. Then also they have used extensively the digital solutions to address this problem. M-Pesa, for instance, it's a private sector wonder. Vodafone's M-Pesa that has revolutionized access to finance since 2007 in Kenya and other parts of Africa. And they provided an entry-level e-payment platform to a large percentage of population. and 2/3 of Kenyans are actually using it. And not only that, 25% of Kenyan GDP is actually passed through this kind of window. So emphasize is a huge development in terms of using ICT or information technology for financing the poor. And then in the public sector also similar kind of initiatives are there. I remember this Bolsa Família, that's from Brazil. The former Brazilian president, Lula's one of the innovations, and again it's provide full assistance and digital payment into a card or bank account kind of thing. So these sort of digital solutions are also in the field in terms of providing services to the poor. So the earlier I mentioned about the analytical part of financial inclusion, and now if you look around in the practice, it is not a new word, but it has been going through different levels of transformation over a period of time. Then now coming, we can look into some of these policies a bit more, and you see, it started with the G20 summit in Pittsburgh in 2009, and then followed by Maya Declaration. So they accepted the large number of working age population who don't have financial account or any sort of links with the formal financial sector, and that is considered as unbanked kind of one. So that is a more or less standard boundary of the definitions on financial inclusion. So words may change here and there, but currently the broader application fits exactly with that. But again, most of the mainstream financial agents were reluctant to accept the developments in the field at that point of time. So although it started in 1978 in Bangladesh, and the next 20 years, the mainstream banks were shut their eyes towards this kind of developments happening. First of all, it's a very small range of business and they are not getting it. But at the same time, in the early, I think early part of the last decade, people actually started to quantify. I'm not sure about the data behind the quantification, but they come up with some very powerful figures saying that if you bring them into the pattern or into the financial inclusion framework, then you can get substantial sums into the national economy. So their role is very important for financial inclusion. So that is where from a policy point of view, policy action point of view, financial institutions have started to think about, okay, good, how we can bring them formally and how we can mainstream these activities. And national governments also started to think more in line at that point of time. And in a SIGA policy paper, Kull and others in 2014, they said, look, this is an effective method. It can improve targeting and it can improve the impact of your social safety net transfers, and it can reduce the transaction cost. And more importantly, it can bring private sector into the global development. Because although in the Millennium Development Goals, the discussions are related to Millennium Development Goals, the role of private sector was highlighted, but it was not clearly, explicitly stated in the document. And it happened in the SDG debates later on, and now it's clearly accepted the role of private sector in global development and how we can get them into the development debate. And it is very well noted in the 2030 Sustainable Development Goals document. But as a matter of fact, it is a challenge. It is a challenge to reach to the larger part of the population across the world and bring them into the financial inclusion. But have we done enough in terms of addressing those challenges, addressing the magnitude of those challenges? And I think that's a very interesting question I just want to pose in this presentation. And in terms of data, I think it's very important, and we don't have enough data to know about how adults save and how do they borrow and how do they make a payment and how do they manage financial risk. But that one kind of a global data available in this one, that's the fintechs, and started from 2011 onwards every 3 years. So we got a 2014 and 2017, and very soon the next round will come out. So it has given some kind of indicators. Again, 69% of adults have an account with either with a bank or a mobile money provider. That's very important, and it has gone up from 51% in 2011 to 69%. But it also noted the unbanked women, and that they constitute about 56% of the total unbanked population now. So that is there. And then they have also looked into various reasons. And interestingly, we normally consider they don't have money, so they don't save, or they don't want to engage with the financial inclusion. But it is not like that. It's a reason, money is a reason, but they have also identified other factors like lack of trust, how cost effective is the operations, and many other factors have actually cited in that database. I'm not going into the details, but I just want to highlight that. So this database covers the global picture of financial inclusion there. But most interestingly, if you look into this figure, nearly half of all unbanked adults live in 7 economies. And the China, you can see, with the 13%, and India with 11%. So after China and India, a few other countries, and then the rest of the world, 54%. So if you look into the previous data on financial, how many people have opened accounts since 2014, you see that large percentage of people are from China and India. We'll come to that in a minute. So similarly, in terms of fulfilling the remaining part of the global population, the main contribution need to come from India and China in that context there. So why it's not happening? Because we know this issue very well. We have achieved, we have started a large number of bank accounts since 2011. But there are two issues there. One is access and usage. So do you think all these people, all the population who got access to the financial accounts, are they using it? Because that's very important. This is an entry-level account. In many cases, it's an entry-level operation. So once they are into that financial loop, and how fast they are moving up in that ladder, that's very important. So that's a one kind of issue there. Then the kind of supply side there. So one issue, obviously, people normally say, look, the financial products are there, but have you ever thought whether these products are appropriate for a large number of individuals, and are they affordable, and are they sustainable? That kind of issues very much there. And I need to share my own experiment here through my association with International Cooperative and Mutual Insurance Federation. We started a project of 555. So basically, we aim to enhance the coverage of mutual micro insurance by having 5 million more clients in 5 countries in 5 years. So that's what we call 555 strategy there. Because of COVID and all, the project got delayed, but so far we were able to extend the micro insurance products to about more than 3.2 million population in different countries. But interestingly, while I was working with that team, I noticed we have not introduced any new product. We have introduced the same kind of product, but we introduce some kind of marginal variations in terms of collecting the payment or calculating the payment or incorporating some of the events which were not part of it earlier. And that has made the wonder. For instance, in Sri Lanka, I remember in 2010, as in my research, I noticed that in many areas it's not really covered. For instance, snake bite. In one area, the cause of death is snake bite, but insurance companies actually not included that in their classes. So, so later on, we were trying to rectify some of these coverage issues, and also their employment is quite seasonal. So, in terms of repayment or payment of the premium, they need some kind of flexibility. So, we introduced that sort of elements. And because of that, we were able to attract more than 3.2 million clients into the microinsurance one. So the point is, suitability of financial products is an important issue, and you need to look into the profile, the need of the clients, and any sort of minor changes. It's not about a radical changes, but any sort of minor changes will bring a large number of customers to the for there. Then coming to the governments, because governments definitely the link is established now, the financial inclusion and development. So they need to push for greater access and financial services. So naturally, the question will be how they can achieve that. First of all, accept the knowledge frame, that is the group banking. The importance of group banking is there. They need to accept the community banking savings group and to what extent they provide the group accounts. They need to link formal and informal sectors, and all those issues are needed. I'm not going into the details of those issues, but they are the one we need to facilitate more government involvement in this frame. But let me move on to the commercial banks, because they were the large players and who don't want to get engaged with this kind of financial inclusion activities. But over the years, many banks across the globe, and they started diversified their operations. For instance, Equity Bank in Kenya, it started in 1984. But by 2010, they started the microfinance level operations, and that has become their main activity now. And they are serving poor, and that is considered as a main business line for that particular bank. And in some banks, they created the loan service companies, and many cases you can see from countries like Haiti, and in Lebanon, many people, they try to invest equity in a microfinance organization, maybe because of an ethical reason, ethical and religious reason, but they try to invest in microfinance. And then the case like ICICI is a big example, because they have got more than 3.5 million clients, and one of the largest private sector banks in the country, in India, and they followed a partnership model. The Equity Bank, they followed an agency type model, but here it's a partnership model, and they contract microfinance operations with the self-help groups and other microfinance institutions. Then from East Europe, you can see the idea of wholesale lending. And then comes the two important things. One is about no-frills account and small banks. The small banks, India is a classic case, because as in the case of organizations like Bandhan Bank, from a microfinance organization, over the period got experienced and then moved through the banking structure there. So they got their license. So that's sort of an operation at one end. And then we all started the no-frills accounts such as PMJDY, a great kind of activity. And I'm discussing PMJDY and the Masansi account in South Africa. So these two accounts, the classic case of no-frills, and you can learn from each other's experience in terms of designing and the sustainable operations of these accounts later on. So coming to PMJDY, it is quite a popular one. It's a nationwide scheme by the government of India, and for financial inclusion to every individual who does not have a bank account. Some of the details we all know. But it follows a long line of state-led initiatives there. We have a long history of bank branches, the expansion of bank branches, and then the regional rural banks, operations by organizations like NABARD and many others are actually working there. But PMJDY gives some kind of a focus, some kind of a cohesion to the whole app operations we witnessed towards low-income population. And PMJDY is actually the face of India's. In terms of size, it's one of the largest, largest in the world, and so it attracts quite a lot of attention because of the size of the scheme. So the scheme, it aims to provide the financial services and the banking, savings, deposits account, remittances, credit, insurance, pension in an affordable manner. And we have about 416 million new accounts now. And you can open an account with a zero balance. The account holders will get a RuPay debit card that can be used across the ATMs, and 306 million. So all these are very positives about PMJDY, but you need to understand the fact that out of this 416 million new accounts, about more than 20 million accounts started during the COVID period from the March of 2020, because to avail the government's incentive scheme, many people joined there. And yeah, so yes, it's a kind of narratives around that. I'm not going into that part of discussion. Then, if you look into these accounts, you see that about 25% of accounts, they have zero balances, 38% no activity, very marginal, the percentage they use the overdraft facilities there. But what is striking here is that we have a banking structure where the public sector banks, private sector banks, and the foreign banks like that. But most of this is actually done through public sector banks. And out of about 414 million new accounts, about 329 million accounts are mainly from public sector banks. And similarly, in terms of RuPay cards, also 261 million. So it puts some sort of pressure on public sector banks, because public sector banks, it's mandatory and they can't run away from that. And we know that public sector banks are going through structural transformation and many other issues in the recent years. So, naturally, that triggers a question to our teams. And in this particular issue, my colleague Sherry Marcos and Osley Peterson, and we started to look into to what extent the sustainability issues for financial inclusion pose some kind of a double bind problem for the banks in the context of PMJDY. And double bind problem is faced by the providers. First we want to see what is mentioned in the literature, but surprisingly, not much evidence from that literature, except Beck and Torre in 2006. They argued that the fixed cost, it can constitute an important limitation to outreach in the provision of payment and saving services. So that can be considered as a key barrier to the broadening of access to financial services. And they further argued, unless you identify a way out to rise the transaction volumes to size scale economies, the low-income clients with the need for small and few payment and savings transactions, that would not constitute a profitable line of business for most of the banking institutions. So basically, they said you need to you need to rise the transactions volumes to size the scale economies for these kind of operations. And then Kochar with Rangarajan and Chakravarti in a policy paper, and they found out that's something like a closest one can find out there, the need to measure the funding gap related to the intrinsic loss making aspects of no-frill-based accounts for BPL customers. That involves the rural outreach using the corresponding bank agents. So the funding gap measurements are based on very highly granular data in specific areas, not a nationwide, but the method does not extend to estimates for all banks. It's only a selection of banks. So you can consider. So only these two are the materials which we can identify in relation to this kind of double-bind problems faced by banks. And then there are some literature, plenty of literature available on PMJDY and its impact. And for instance, Agarwal and Chopra, they do large-scale studies based on the proprietary data on PMJDY accounts from the public sector banks. And one of the key findings of these studies is that there is a potential to merge PMJDY and non-PMJDY account in the times to come. So that's there. And then Shamshika Ravi used a field survey data and find the regional disparities. So that's a different issue about the regional disparities. So all these studies have not looked into this particular issue of double-bind problem. So to address this issue, we try to quantify the incentives and cost involved in targeting the unbanked households. And because there is a government subsidy for opening these accounts, and they can have some benefit from the government. But whether is that enough for them to carry on the short-term and medium-term challenges? So we focus on the supply side funding gaps inherent to these financial inclusion schemes and its impact on the sustainability. And banks struggle to achieve economies of scale to drive down the average fixed financial infrastructure cost. But the average account balances, they are not large enough to cover the gaps in the income of BPL customers there. So we used the cross-sectional data here used to quantify incentives and cost involved in targeting unbanked household and try to estimate a monetary estimate, try to calculate a monetary value for the economic shortfalls or surpluses for these participating banks, mainly measured as bank balances related to their cost and subsidy per PMJDY beneficiary. And interestingly, we noticed about 17 of banks. Of course, this is just before the bank merger and like that. So previously, there were a majority of 17 banks. They suffer shortfalls in terms of insufficient bank balance per PMJDY account. And this is very worrying factor because we all know that there is a 8 out of 11 banks has been under the prompt and corrective action of the Reserve Bank. So in that context, it is very significant to see this particular issue. So we try to conceptualize this issue, and here, as you see in this figure, we have an average infrastructure or the operation net cost curve, and then there is an account balance curve, and we plot each bank, what is the average account balance, the average what is the account balance, and what is the net cost, and then looked at the sector averages, and we placed the banks there. So that's why we calculated the 17 banks below average in terms of their coverage. But as you see from this figure, the intrinsic loss-making bias of PMJDY account, it rises from the low average balances. You see here the low average balance, low average balances here. And I can say one example of State Bank of India. State Bank of India, they have actually more than 20 million accounts, PMJDY accounts compared to the average account. So that is something big, and that went in hand in hand with the average PMJDY account balance of 68 rupees for each account for State Bank of India compared to the sector average of about 1,000 plus rupees, like that. So the average infrastructure curve in this figure, that indicates even at the lowest point of the sector, the scale economies, it cannot drive the average cost below the average size of account balances. So that poses a big problem. So the funding gap per account in financial inclusion schemes, that's emerged as an intrinsic problem where the policy makers need to focus on. And we also estimate how many years required for each of these banks to move from that phase. And on an average, we estimate about 4 years by connecting or by enhancing their operations through the direct benefit transfer or the cost of overdrafts and the commissions, etc. And so I think it's more or less in the same position like Das and Sriram argued earlier. The service for the poor, that becomes poor service due to insufficient economic returns. So that's emerged as, or otherwise, unless if government thinks it's a mandatory and it's a duty and it's a prerogative for the financial inclusion, they need to adequately incentivize public sector banks for that. Or otherwise, we are actually affecting the fundamentals of public sector banks along with a good objective here. And if you look into the private sector banks, they by and large kept away from here. But like ICICI, they made huge investments in ICT. So it can actually reduce the transaction cost probably in the coming years. And also Government of India is thinking about expanding the social security budget and distributing through these accounts. We have seen in the case of COVID, although the amount is very I would say is not big enough, but I think that the process of transfer of money through the bank accounts, that's a new thinking, and new thinking has occurred. So, my message so far here is that we need to. So my message, so I have some more time, sorry. My message so far here is that we need to incentivize the institutions in the public sector to carry on with this agenda. Then the next issue, which is more on the demand side, one is whether do we have enough information capital. And the lack of information capital, does it pose a challenge to financial inclusion? And here we looked into two types of information capital, media and social networks on credit diffusion and financial decisions. And we used the French sociologist Bourdieu's thinking, particularly about the capital framework and social reproduction. So according to Bourdieu's argument, the actors' position within different social fields, that actually matters in relation to what type of capital you possess, the nature of capital. That's very important. And his theory of social reproduction in relation to capital, he looked at from economic capital and then social capital and the cultural capital. So the theory of social production is related to the different kind of capital there. So here we want to introduce a new set of capital to that discussion. That's about information capital. So your access and use of the channels of media, social networks, whether it exchange more information between various groups, or whether it influence your economic behavior, your financial behavior particularly. So we looked into the media networks, how often you access various media outlets, and also by the head of household and also by the members of the household. Yeah, that one. And then we have some literature which says that the target audience is large, then the harnessing the media can prove to be an effective method to reach out there. So social networks, then comes the social networks. The social networks, are you part of one group, or are you a member of multiple groups? And do you attend the meetings very regularly? Because again, some evidence says that when people become members of a group, when they're expected to attend the group plus activities, as I said in the case of microfinance, where the microfinance plus activities. And in our own research, we found out with Samuel Lenim and Arun, we found out the types and combinations of capital that really matters in terms of well-being. Because in India, if you look into the consumption expenditure, you see that the knowledge, you possess a certain amount of X amount of knowledge, mainly related to how many organizations you are participating in it. So if you are a member of one group, you have X amount, and then you have two groups, then X plus Y, or X plus Y plus Z. So it goes like that. So the membership in multiple groups actually provides quite a lot to that debate. So the social assets, they are expected to be some kind of catalyst for connectedness, both vertical and horizontal. And it also brings kind of responsibility on a collective basis, and also sharing more information. So here we used propensity score method to match the like-for-like comparison for the households with credit or without credit. And interestingly, the media awareness that's higher among the urban poor households, whereas the social networks are more dominant across the rural households. And our treated group, mainly with the credit, that tends to have higher participation in many schemes, and they have access to the better networks there, and they have a financial status there. So the diffusion of credit that leads to the kind of social inclusion. So that's the argument which we are driving into here by improving the participation of households in investment, savings, consumption, and insurance schemes. So the low-income rural and urban households with the credit uptake and exposure to media, they are more likely to increase their investments in property, bank savings, consumption, and other insurance schemes. So the crux of the story is that the financial institutions, we need to develop financial programs that harness the social networks and use of mass media as a means to reach larger target groups rather than individuals for an appropriate use of financial products. This is a very important policy finding, because if you look into PMJDY, although we got a good coverage and many parts of the northeastern area and also the faraway lands away from the main heartlands are not actually financially connected there. So you need to target these kind of mass media programs for that region or that set of population to attract them, and rather than targeting about individuals for an appropriate use of financial products there. So we thought this sort of finding will actually help to mainstream the ongoing financial inclusion activities there. And we also noticed, as I said earlier, in South Africa, South Africa is a country, if you may remember the graph which I showed in the first time, and their financial inclusion is quite high compared to the other countries in Africa in that sense. But until the end of apartheid regime in 1994, financial services were dominantly non-Black community, so excluded the economically weaker households. So that was the situation there. So they changed that situation from 1994 onwards. They also started a no-frills account like our PMJDY. It's known as Masansi account. Masansi, there's an intervention. It's again is organized by Finmark Trust in collaboration with the DFID and some other external funding agencies. And Masansi account intervention mainly replicated the usual strategies of a no-frill account. It started in 2004 as an entry-level account. 4 main private sector banks, and ABSA, NetBank, First National, and Standard, and they coordinated a rollover of a standardized basic account, and from 61% in 2004 to 86%. So it's a big growth you can see because of this Masansi account there. And what we have done is we looked at this Finmark data of 2 cycles, and mainly to look into the perceptions and behavior and access to and use of different types of financial services. And we noticed the most of the Masansi account holders is a different kind of perceptions and attitudes. They have some problem in understanding the financial terms or the financial advice, the lack of trust. All these are very much exist there. And it was a hugely successful program from, I would say, 2004 to 2014. But by 2014, the banks realized, look, this is not a profitable business for us. What we have done is remarkable from a political point of view, because we have extended the financial inclusion, but as I say, and we have opened up the unrealized demand for financial services. But in terms of the use of this account, the same like PMJDY, what we see now, it's not much happening there. So the big banks, what they have done is they found out the market is huge. There's a mass market there. And what they have done is they actually come out of the Masansi framework and introduced some kind of innovative and cheaper, affordable products. So although it ended the Masansi product in theory, it has actually paved way for a new range of products there. So the point is the financial inclusion or the use of or the engagement of the lower income population in terms of the financial services actually moved up quite a lot at that point of time. But it actually moved away from PMJDY. So I remember one of the findings which we mentioned earlier in terms of the banking sector point of view. We assume there is a possibility of converging the PMJDY and non-PMJDY accounts in the future, because you may not find it conducive to continue the no-frills account alone as a significant part of the bank operations there. So in terms of, let me conclude my views on these issues. So we looked at this mainstreaming. Financial inclusion seemed to be a main policy agenda, but the main players, the commercial banks, I think they started to enter into this field. That's really good, because that gives a much required boost to the financial inclusion agenda. So that's coming up in a big way. It's a very positive one. But it also raised a set of issues about the sustainability challenges for financial inclusion, in terms of funding gap is there, and also we identified to what extent information networks and other kind of attitudes and behavior really matters there. In South Africa, we noticed some kind of a voluntary exclusion of households, and they assume this is not for me, and why should I participate in the financial service? This is something different. I think that's a very, I think we can see a similar kind of trends in India as well, the voluntary exclusion of many people. So the government's DBT schemes and like that may be an appropriate incentives for them to participate. And particularly in the COVID period, these 20 million new account holders justifies that these incentives can bring more people into the forum. So that is there. So these kind of structural and behavioral issues there. But let me conclude with a very positive note about the future of financial inclusion agenda, particularly in the context of using technology. And nowadays we know that using blockchain technology, remittances, at least in the field of remittances, a big change happened. And more standardized products across various countries, so we can reduce the money transfer cost, and then the people can get benefit out of it. But many of these technological issues raise quite a lot of regulatory issues from a national point of view. So, but at the same time, we need, I think, at least for the sake of sustainability of financial inclusion, we need to have more open approach in terms of using technology in terms of facilitating the financial inclusion there. And also, I need to emphasize that the microfinance institution or alternative financial institutions, they still have a major role in this one. And don't assume that most of these NGOs are not necessary, or these, because they have done some very good work. And they also showed the kind of institutions which can innovate over a period of time. That is something remarkable. As I said in the beginning, the innovations happen, the financial innovations happen in these institutions seem to be a very positive trend. So I hope the technology can streamline some of these activities in the coming years. So these are my thoughts on financial inclusion and to what extent we can mainstream these activities. Thank you. Thank you very much for your patience, and I'm quite happy to engage with any kind of clarifications or questions now. Thank you.
Thank you, sir, for giving that excellent account of various challenges in mainstreaming financial inclusion. I now open the floor for questions, comments. You may please unmute yourself and ask your question, or you may even type it in the chat box.
I can't, shall I can't see my chat box here.
Right, sir. So if there is any question on the chat box, I will read it out for you in case you can't see it. I will read it out for you, but it's on the right side, just below. Yeah, so there'll be participants, and next to it, you will see the chat box on the bottom right corner of our screen. That's where we see it. Bottom right.
Arun, you have to stop sharing your, then you can see it.
Oh, okay.
Oh, yeah.
Yes. True. Yeah, thank you. Thanks, Arun. Thank you.
Hi, can I ask a question?
Yes, please.
Yeah, hi, my name is Sanjay Padke, and thank you, Dr. Arun. That was a very interesting presentation. My question was in relation to the ending of the talk on using technology in the context of.
You're not audible. Could you speak louder? Speak into the mic, please.
Sure. Is this better?
Yes.
Yes.
Yeah. So my question was in the context of financial inclusion and using technology and blockchain, as you mentioned at the end. What do you think is the potential for central bank digital currencies in this particular perspective? And do you think they can be combined with the DBT, with the no-frill accounts and the other, non-cryptographic innovations that have happened?
Yeah. I think my initial take on that issue is, yes, blockchain has that new technologies, that it has the potential to provide everyone with a much more faster and safer way to verify the information, and also to foster trust in the process. So that's very important. For instance, blockchain, one of the issues is about the high fee issues. And if we fully adopt blockchain can enable a near real-time and accurate payments. So obviously that reduces the transaction processing cost here. And also we are not using a third-party intermediaries there. And blockchain, so obviously it powered virtual currencies and that, so people can send payments globally. So although I agree that it constitutes a new universal means of exchange, it's there. But that frees the individuals from paying a currency fee while transferring money to the different countries there. So that is a kind of a decentralized approach. If you detach from this view and think it's a decentralized approach to identify the management and manage the social and financial entitlements here. So I assume, yes, there are. I know that we have not developed many of these technologies, quite formidably, but at the same time, in terms of potential, even enhancing, know your customer efforts and reducing the burden of time and cost associated with gathering personal information, etc., would be useful. But a very important player in this whole game would be the regulation, because regulation is very, very important. Because many people, even many educated people, they don't want to engage with many of these new technologies, assuming the potential pitfalls of this. So in this context, it is much more important to develop appropriate regulatory instruments to streamline these operations. But definitely it can do much more in terms of streamlining and also mainstreaming, streamlining the financial operations and also mainstreaming the financial inclusion activities there. Yes, so particularly considering the remaining 1.7 billion of the world population who are right now unbanked, and considering the fact that majority of them are in the urban areas. So we actually moved the nature of debate from the rural poverty to the urban poverty now. And because of our massive growth of urban centers, I think the low-income population will be mostly in the urban areas in the coming years. And then it would be much more conducible in terms of infrastructure to facilitate these kind of new technologies to mainstream the financial inclusion activities. Thank you.
Okay, any more questions?
Can I ask a question? This is Nagaraj.
Yes, sir, please, sir. So we can hear you.
Okay. You, Arun. I have a few questions. Can you hear me?
Yes, sir. Yes, sir. Thank you.
Yeah.
Thank you. Yes, sir.
Yeah. I mean, it'd be nice to get a kind of a global picture of, what's happening on the financial inclusion. That's very nice. But I have effort at financial inclusion during the last 2 decades. Can you say how? Sorry. Hello.
So actually, we lost you in between. Hello. So, but now we can hear you again. So,
Okay.
If you could just repeat that question once more. Thank you, sir.
Okay. As I said, I think let me see. Those so many new accounts have been opened across the world, especially in India and South Africa and others. What can you say? How much has it led to mobilization of savings, or what percentage of total credit, bank credit, has gone to these poor people who have opened the accounts? Has there been a significant improvement for that? See, ultimately, this is the essence of banking, that they should have access to banking, and they should be able to get credit. I mean, that's the essential function of financial intermediation, okay, in any traditional understanding of banking. And have they improved? Can you give any country-wise evidence on that? That's the first question. Second, I seem to take a very positive view of the role of NGOs in this. And I think I think it's quite debatable. I think everybody talks about Grameen Bank in Bangladesh. We also know that they have led to a number of negative sides as well. Despite all the Grameen Bank growth, it has not improved capital formation. Okay, that's the ultimate test of a spirit of banking. Okay, and it has only smoothened consumption. And more recently, I think there have been lots of negative things. That's the reason why the government has practically has put heavy regulation on the Grameen Bank. So it shows that there are a lot of things not quite right with the NGO-led development. I think one needs to know. I would like to know more about it if you can enlighten. Thirdly, about India, you must tell me what has there been a subsidy for? To my knowledge, there is nothing. There were public sector banks are forced to do it. Private sector got scot-free. Okay, so I don't think there's been it's been a burden on public sector. Okay, so incentivizing will surely help. Okay, but more importantly, because there is a feeling that government is going to give them credit up to 15 lakhs. In fact, that is a promise which the government made during elections, which is why people opened account. Okay, so I think the government effort has been quite frivolous in an economic sense. Okay, so what do you say to what I've said? Thank you.
Thank you, sir. Thank you for this very interesting and thought-provoking questions. I think it's really important. It actually enriched the whole debate. And going back to the first question about the savings and to what extent people actually migrate into financial services. I remember in our South African study, what we have done is we classify the users into 3 different categories. The people who are just accessing the financial services, they are accessing and savings using the financial investments, and accessing, saving, and investing the financial resources. So we thought these 3 steps are very important. First, a credit line and a savings line, and then an investment, and then for investment, insurance, etc. So that shows the kind of financial knowledge one could acquire over a period of time in that one. And we noticed very small percentage of migration happened from the first stage, that's the credit line, to the savings, and much more lesser happened from the savings line to the third kind of category. So this kind of journey from the financial ladder. So so in essence, that point is very important because it provides an access to the entry-level account, but in majority of the cases, it stops there and there is no movement after that. So that is something worrying, and that's why I said in terms of innovating the financial products are very important, and also you need to sustain your interest in these products for a long period of time. Then only they can engage it. But at the same time, we need to accept one fact that these things don't happen over a very short period of time. You need to engage with that. Like our self-help groups, they sit together and share their initial pool of savings. But over 6 months, 1 year, they naturally learn the process. And when they see the benefits, when they get from organizations double or triple or whatever it is, X times of their actual savings by the members, and then they play from there. So it is very important that you need to migrate it. But the first step is, what is important is the first step is the access, and they need to taste the product. Okay, this is what is happening, and this is the way I can use of it. So globally, so far, our evidences in terms of usage of financial entry-level bank accounts is very low. I have looked at the same issue in the case of Tanzania and many other places. But at the same time, the organizations which use digital technology, such as in the case of M-Pesa in Kenya, and there the people started to use this instrument for the digital transactions for savings and other purposes there. So you can see that with the use of digital technology, you can push the borrowers to the second or third level. We don't have much evidence, but at least to the second level. So that is possible there. So again, technology can play a big role in facilitating that kind of one. Then coming to NGOs and microfinance organizations, I think in my writings, I take a stand. It's not a magic bullet. It's not a silver bullet in that sense in one of my previous writings. But at the same time, what I mentioned here is about the innovative aspect of these institutions. They have actually revised the products over a period of time. That part I have highlighted. But at the same time, there's a selection bias there. And many of the microfinance impact studies have identified the selection bias of borrowers, and also the intra-household allocation is an important issue, as we all know, and that leads to the wider gender debate by Naila Karim and others, in many places about they looked into the impact on gender and to what extent who is controlling the resources like that. So that kind of issues are there from a critical point of view, you can say there. But at the same time, if you look into a case of Bandhan, because Bandhan is a classic case, and many of in Pakistan also, one of the microfinance organizations been converted to a microfinance bank in some time early part of last decade. So these banks, these organizations can actually move irrespective of its limitations, the skewness of the product structure and all these things. There is a possibility for these institutions to move up, and they have been actually in the field, irrespective of the bad press at some point of time. They are actually doing their business quite well there. Initially, they were not regulated, so that led to the problems as we see in the case of Andhra Pradesh and many other places. But nowadays, it's a much more regulated and it's a regulated industry in many sense. And also data is much more available these now. And also in a self-reporting basis, but the data portals are there. It's quite transparent. That part is there. So my take on that one is, yes, the NGOs, they have some limitations and they have received bad press at different points of time, but none of these actually reduces the nature of operations, rather enhances the product structure and move there onwards. So that's there. And coming to the third point about the incentives, and public sector banks actually do get kind of a book accounting kind of incentive for starting one account, but it's nothing compared to the actual cost of running that account. So in a way, the banks are actually, as you rightly mentioned, the banks are actually heavily pushed towards this. And that's why they started more and more account there. And people normally join there only because of incentives. So the incentive structure is much more important here. Without incentives, as I mentioned in the case of COVID and in other cases, as your perception about this 15 lakhs and many of these incentives, either the presence of these incentives actually really matters there. Again, the crucial point is going back to your first question. People may be part of it, but how long they will be part of it. And after some time, still there's a large percentage of people accounts are dormant accounts and they are not using the accounts. So that sort of criticisms prevailed right now. But the most important take there, I would say, this is, in a way, many people who used to keep their cash in their hands or and quite informally borrow from the money lenders like that, they start to see these institutions. Obviously, the next step would be they need to save it, and it should support the capital accumulation eventually. But how far it will happen is a big question. So the challenge would be here is access is one part of the story, and we are actually dealing with the access. And I'm sure that the next few it may need, because in the case of PMJDY, it's actually extended till 2012. And so, like in the case of Masansi, you can see that Masansi runs from 2004 to 2014, so 10 years of operations. And by that time, the bank said, okay, now these people are there. Now with the new products, we can go and embrace them. So in a similar vein, I assume we started in 2014, and now it's up to 2012, maybe one more time. So by that time, the banks will realize, look, this is a great opportunity. Now we don't need PMJDY. We can move on and grab these customers to the mainstream. So looking from finding parallels between these cases, I assume, as I mentioned in the presentation, PMJDY and non-PMJDY customers will merge at some point of time. I hope I have reflected on your queries. Thank you. Thanks.
Thank you. Thank you.
So we have two questions on the chat box. Shall I read it out for you?
I think I can see the chat box now. Yeah, thank you. Thanks. And go to the first question from Lavanit Kaur. You have mentioned the role of social media enhancing. As you have mentioned about the role like social media, could you please some light on your views towards the role of financial literacy, like the role of education, behavior and attitude towards it? Yes, I think it's a very, very interesting question, because that's the one thing which I have not mentioned in the presentation. But financial literacy plays a very important role to boost the financial inclusion. And financial literacy, the most interesting issue is when COVID happens, many of the Western countries, they moved to online for all the activities. So obviously, people are actually pushed to use online banking facilities there. And considering the demographic profile of population in the West, it seems to be a very daunting task for institutions to ask many of the older age population to engage with online financial transactions. So it creates huge pressures on the system. But it's not the problem of, interestingly, even if you look at the young age population, they use, internet and other facilities for everything. But in terms of financial transactions, rather than the infrastructure, you need to know the fundamentals of credit or debt, and the use of credit, use of debt, etc. And in many cases, we noticed in one of the surveys, we noticed that many of these younger population also don't have enough financial literacy. So financial literacy per se is an issue very much important, irrespective of the age, I would say that, because it's quite important to understand the use of finance, the better way of using finance. So the financial literacy programs are getting much more popular, and particularly European Union, they started massive educational programs, and there are so many online programs available, and many NGOs are taking lead in terms of implementing these programs. So globally, there's a massive effort going on in terms of expanding financial literacy activity. So I fully agree with you that it's very important. And also personally, I can say that I am starting a program, particularly in some selected schools, about incorporating some of the financial fundamentals, financial management fundamentals of financial management into the curriculum. Because in our curriculum, although they learn about many big things, but they don't have enough space there to learn about how to manage their own finance there. So I think it's a very, very important suggestion to get it included in the financial, into the normal curricula for this. The next question is from Iqbal Rahman. Iqbal Rahman's question is the reasons for regional inequality in achieving financial inclusion if the policy is for whole nation. But there may be different reasons for the regional inequality. In many places, they are distanced from the main course of main narratives there, so that really matters. Infrastructure matters. In some places, they don't have enough infrastructure to engage with that. Or although we have expanded the bank branches substantially during the last few decades, in many places, the bank branches seem to be a major concern in certain areas. So that kind of factors might have. I haven't looked more closely into this regional inequality issue, but I assume these factors are really important. The level of education is important. Of course, the level of financial education is important. And how far the central periphery arguments are still valid, how far they are from the main center of operations. So that could influence their inequality issues in achieving financial inclusion. So overall, I would say, yes, that sort of factors really contribute to the regional inequality. And then Iqbal further says about why there is regional inequality. I agree that it shouldn't, in an ideal world, it shouldn't happen. In a perfect competition, it shouldn't happen, but it still exists. It exists because of a range of structural factors, a range of structural factors mainly contribute to that. And Lemonade pursued the question on financial inclusion, and the next one is, would you be able to suggest some ways how will you include financial literacy fundamentals into our education system? True, it can include it into the education system. Like we learned about. I always make jokes of this because I learned about the history of many parts, but at the same time I don't learn much about the civic sense or the civic consciousness or the stuff which is useful to me in my day-to-day life. So it's very important to learn about the historical issues in globally and faraway lands. So that's very important. But at the same time, I like to see more about the day-to-day life. How as an individual, how will I manage my life? I think that's the best lesson one should learn, one should gain through the education system. And unfortunately, we don't have that. So I think it's very, very important to include that. And a very basic money management packages, very basic money management, how the money is actually coming to the household and how it's distributing. At the end of the day, how much is left out and what is the savings there. And so at a very young age, if children learn about these sort of money management issues, or we assume at that stage children should not learn about these kind of things. This is for adult, but it's not like that. They should learn about the household income and household expenditure and how they are managing the savings for what kind of purposes. So that kind of an awareness would be a very good start at the primary level, and from there onwards, they can build up the knowledge as and when needed. And there are a few questions in the chat box. Some of them are in a continuous nature. Yes, the business correspondence in promoting financial inclusion. Yes, Iqbal, business correspondence plays a very important role. We actually calculated the cost of having a business correspondent and starting the branch there. I can't remember the exact cost, but it is possible. It is possible. Business correspondents can do a big job there. Private sector banks are reluctant in providing services through business correspondent. Yes, obviously, their nature of operations is slightly different. They rely on technology, and it can actually do that. So why I don't have an answer to that question, why the private sector is not using the business correspondents. How financial inclusion helped rural women in India. Yes, that is the second, my second take is actually the female-headed households, and we made a classification between rural headed in the rural and urban areas, and we saw that the financial inclusion has a varied kind of impacts on rural and urban women. So that is there. And then Shonima Neliat asked about the Mudra policy in the light of increasing NPA. I haven't looked into the details of that one, the study, that particular issue, but at the same time, from anecdotal evidences and my own knowledge, the general knowledge on that issue, yes, it actually contributes quite a lot to the NPAs of public sector banks, and the whole Mudra policy. Yeah, I hope someone will give a detailed study on this issue. But the whole Mudra policy, my understanding is that it has been used by governments with different kind of purposes. It's different from the financial inclusion policy. The financial inclusion policy, or the PMJDY, is mainly, it has a target. It has a target away from any sort of interferences. But the Mudra policy, it actually lead to a preferential treatment in terms of allocations, and there are some big cases of evidence, big pieces of evidences there. So I think it might. My hunch is it might, but we need more evidence to say it accurately. Overall, but I think I think those are the questions I can see in the chat box mainly. Ritika, yes.
Right, sir. So thank you so much. I think we are just on time, and if there are no more questions, okay. So, sir, thank you so much for this insightful presentation highlighting the supply and demand challenges related to mainstreaming financial inclusion in India, and the discussion on the role of ICTs, or especially information networks, was certainly very insightful for a lot of us. I would also like to especially thank you for taking time out, and we really hope that next time when you're giving us a talk, you would be physically present over here so that we can enjoy it even more. And I would extend my thank you to all the participants for having such an interactive session. With this, I close the session. Thank you, everyone. Special thank you to sir.
Thank you, Ritika, and thank you, CDS, and thank you all for your comments. And I look forward to continue this sort of engagement with CDS in the coming years. Thank you very much.
Thank you, sir. I close the session now. Bye, everyone. Thank you.